Okay, here we are. Good morning, everybody. It's 10:04. I understand we're a couple minutes late. I'm sorry about that. Uh I had a little bit of fire engine activity on the way into the office. I come here to the office on most Tuesdays just to do this broadcast for you live. Um, Wednesdays and Thursdays are our in-office days to meet with clients, and I come in Tuesday mornings to do the webinar. And so here I am. Good to see you all. It's been almost a month. It's hard to believe, but it's been almost a month. So we had a couple holidays in there. I had this. I walked out to get in my car a few weeks ago, and I had this enormous tree covering both my pickup truck and my daughter's car, and so I made the decision to deal with that, which was a good decision. At first, I thought I could just pull back and clear it, but it was a massive branch, and I had to have a tree company come out and take care of it. But everybody, as I told you in the email, everybody's fine. Just delayed our discussion about investment indices for a couple weeks, but good to see everybody, and let's get going with this. So. We're going to do a review of our topics or how we go through the webinar. So we're going to spend the first few minutes talking about the slot updates. We'll have market updates and analyst reports for about 15 minutes. And then our financial planning topic is again a big one. So I'm going to try to keep it down to 15 minutes, but I'm not really optimistic. But what we've decided to do, I've talked to some of my folks who help me with videos. What we've decided to do is we're going to start breaking down the financial 15, which, let's be honest, has gone well over 15 minutes most of the time. We're going to break it into several videos. So I don't know when that's going to happen, but I think it's a good idea, and it'll give you the ability to watch the entire broadcast. So you can watch the entire webinar from the beginning to end. That includes the everything I just reviewed: slot updates, market updates, and analyst reports, and the financial planning topic. Or you can break it down. So we'll have the first portion: slot updates, market updates, and analyst reports. Excluded from the financial 15, but the financial 15 will also be broken down into segments, much shorter, maybe 5-minute segments, but we'll see. We'll figure it out. And as everything, we're always evolving. So speaking of evolving, I hope you've checked out our new website. It's the same URL, attleboroughwealth.com. I absolutely love it. I hope you do too. I hope you find it beneficial. And perhaps next week we'll spend some time doing a tutorial about that. I told you that we're sponsoring what they call the Colt Vault at the Newtown Theater this summer. We saw The Big Lebowski with some friends a few weeks ago, and that was a lot of fun. Clerks is showing tonight, and then we have The Spinal Tap on July 18th, and Escape from New York on July 25th, and Tremors on August 8th, and 300 on August 15th. I didn't choose these movies. People ask me, why'd you choose Big Lebowski? I didn't choose it. The Newtown Theater, which I love to sponsor, just called me and said, would you consider sponsoring these movies for the summer? And what that means is that nobody has to pay for tickets. So because we've basically covered the cost of tickets. So if you want to go, you should pop into the Newtown Theater. It's really, really great. All right. For the headlines this week, we have Consumer Price Index tomorrow. So tomorrow morning, the Fed is back talking about inflation, or not the Fed, excuse me, but the Bureau of Labor Statistics will release the Consumer Price Index, and we'll know what the inflation was for June. And the Fed then will use that data to consider whether they're going to continue hiking rates. And then Thursday, we have Producer Price Index. So we'll get an idea of wholesale inflation, right? So what producers are paying for goods and services. Okay, let's get into the slot update. And again, it's been a month, so I spent a lot of time reading through these updates for you, and I chose two that I hope are beneficial. I'm going to share my screen here with you. So you can see this one talks about understanding that. There we go. You can see the title now: 60-day rollovers and required minimum distributions. And this is by our friend Sarah Brenner. I had a lot of conversations with Sarah over the past couple weeks about items that popped up. Sarah's really helpful to us and our clients for sure. So this person writes, at Slott and team, I'm 73 and a retired financial planner. I would like to do a partial withdrawal from my 403b. That's like a 401k, typically for hospitals or teachers or not-for-profit organizations. So he wants to take a withdrawal from his 403b and do a 60-day rollover back into the same 403b. He writes, can I do this, or do I have to do the 60-day rollover to a different 403b or IRA? Please let me know at your earliest convenience. His name is Robert. So Sarah writes, make sure you can see this. Sarah writes, hi, Robert. There is nothing in the tax rules that would prevent a distribution from a 403b from being rolled back to the same 403b. However, there are a couple potential hurdles here. The 403b must be willing to accept the rollover. Remember, plans can make things more restrictive than what the IRS allows. So you always have to know your plan restrictions and requirements. Also, if you must take a required minimum distribution, an RMD, and the trigger for that was Robert said he's 73 years old. That's the year that required minimum distributions are required. Actually, it's the age, that the required minimum distributions are currently required. Then there is a required beginning date that is April 1st of the year following the year you turn 73. But Sarah astutely recognizes that and says, also, if you must take a required minimum distribution from an RMD, distribution from the 403b, the RMD amount is not eligible for rollover. So basically he can't take that. So if he has $1 million in his 403b and he has to take 30,000, I guess it would be about $30,700 or maybe 30,000. Yes, that sounds about right. Then he can't roll that amount back into the 403b plan. So really great points, Sarah. Here's our next question. My husband retired 20 years ago, and we have been using IRS Uniform Lifetime Table to withdraw his RMDs. The IRA custodian has changed the factor used to calculate his RMDs based on the new table. New tables were released, I think, in 2022. They told us that everyone must use the new table. I thought we were supposed to stick with the table we've been using for 20 years. Am I wrong? Her name's Peg. Short answer is, Peg, you're wrong. Sorry. But answer, hi, Peg. The IRS released new life expectancy tables to be used beginning for 2022, required minimum distributions for retirement accounts. All retirement account owners and beneficiaries must switch to the new tables to calculate their RMDs, even those like your husband who have been taking RMDs for years based on the old tables. This is a good thing for most people because the new tables account for longer life expectancy and will result in slightly smaller RMDs. So if your husband, your husband wants to take larger amounts from his account, he can do so. So good information from Sarah. And then the next one here, this is from July 6th, so I went back a bit. So this is again from Sarah. So I believe we're all waiting for the IRS to issue regulations, IRS to issue rules related to distribution requirements or not for beneficiaries who are subject to the 10-year rule under the Secure Act. Where is the clarification for 2023? In my situation, my children are beneficiaries who inherited an IRA from grandma who passed away in 2022. She had started her required minimum distributions, RMDs, so I know the accounts need to be emptied within 10 years. But there is no clarification on RMDs in years 1 through 9 of the 10-year payout period. When will the IRS update us with 2023 rules and or another waiver? So this is a really tricky question. Just for historical reference, the IRS came out with some guidance following the Secure Act that basically got rid of the stretch IRA requirements or allowances and said that distributions, the IRAs, must be distributed by the end of that 10th year. They came out later with further guidance saying that there must be required minimum distributions during that 10-year period, and then reversed that. And then they came out with further guidance saying there must be required minimum distributions in some cases, and that is if the deceased IRA owner had begun or retirement plan owner had begun receiving required minimum distributions. So it is not a formal regulation yet. It is a proposed regulation, but it's certainly what we're following. So here is Sarah's answer. Your situation is unfortunately very common. There are many IRA beneficiaries who are subject to the 10-year rule and have the same confusion as to what to do for this year in the wake of the IRS issuing proposed regulations. You'll see here, proposed regulations in 2022 requiring RMDs in years 1 through 9 of the 10-year rule. As of right now, I'm right here, folks. As of right now, we have not gotten any further guidance from the IRS on this issue. You may be able to wait a little longer since there is still time in the year, but at some point, so this is July, we're talking July 11th, 2023, just in case you're watching this via video or on YouTube, excuse me. Currently, we have proposed regulations from the IRS requiring RMDs to be taken during the 10-year period. In the absence of final regulations, which could be a long time coming, the safest approach is to follow the proposed regulations and take the annual RMDs. Really great question. So here's another one. I have a unique situation as follows. A son, this is from a financial planner or a CPA, I'm assuming. But a son, age 64, is tragically killed in a traffic accident. The beneficiaries of his IRA are his parents, who are age 92 and 90, respectively. It's my understanding that the parents will qualify as eligible designated beneficiaries. The decedent has 3 brothers whose ages are within 10 years. If the surviving brothers' siblings are named as beneficiaries of his IRA by the parents, do they qualify as EDBs if they would inherit this beneficiary IRA from the parents in the future? So Dan, his name is Dan. Dan's asking if the parents inherit the IRA and then they pass away, and they have now named their other children as beneficiaries. How is that treated? It's a little confusing because you can't name a different beneficiary as on somebody else's IRA. All right, so here's the answer. She writes, "Hi, Dan. Sorry to hear about this sad situation. This is a complicated question. So I'm here. Oops, sorry. I'm here. The parents would qualify. The parents would qualify as eligible designated beneficiaries and would be able to stretch payments over their own life expectancies, assuming the IRA is split into separate accounts. However, given their advanced ages, those payout periods would be shorter than 10 years. Again, these are specific nuances that you have to pay attention to in these rules. Because the IRA owner died prior to beginning RMDs, the 10-year rule would be another option. That would likely be a better choice since no annual RMDs would be required during that period. Because the IRA owner was under his, prior to his required beginning date under the current proposed regulations, there are no RMDs required. You see how complicated this is, folks. If the siblings are named as successor beneficiaries on these accounts, they cannot qualify as eligible designated beneficiaries. Instead, they will be subject to the 10-year rule. Here is where things get really tricky. If the parents chose the stretch option, those payments must normally continue during the full 10-year period. But in this case, payments would likely run out in less than the full 10 years due to the advanced age of the parents. On the other hand, if the 10-year rule was selected by the parents, then the successor beneficiaries would only get whatever remains of the original 10-year period. So what Sarah's saying is if the parents who inherited the IRA say, well, we're going to use because we're eligible designated beneficiaries, we can still stretch this IRA, but because of their age, their stretch would be less than the 10-year period. And then the folks who inherited, their kids, would have to continue that same schedule. I know it's confusing. That's why I always suggest that you reach out to us and we can help you answer these difficult questions. And I listed down here because it's good. I keep these in my notes because these eligible designated beneficiaries. So I'm going to fix that. That should be that. The EDBs are relatively new, and it helps me have these notes. So I'm just going to remind you what they are. They're surviving spouses. So an eligible designated beneficiary can use the stretch IRA option still, and that is take distributions over his or her lifetime. Surviving spouses, minor children of the account owner, disabled individuals, the chronically ill, or beneficiaries not more than 10 years younger than the IRA owner. So they are the eligible designated beneficiaries. There's only 5, and there are no ways around that. So spouses, of course, can also treat an IRA as his or her own, but only spouses. All right, let's talk about our market report. So we talked about the fact that the inflation numbers, the consumer price index, was coming in tomorrow. Let's talk about what happened in the past week. So we're going to first look at the markets, and I'll share my screen with you again. Okay, let's make sure you can see everything. All right, so here's where we were for the week. This is from Invesco. This is not a recommendation to use Invesco or not use Invesco. This is just a group that I like that gives this. I like this snapshot they send me every week, and I like to share it with you folks. And I usually just share the information, but I'll share my screen with you because it's been a little while. So we'll take a look. The Dow. We're going to talk about some of these indices today. But the Dow Jones Industrial Average was down 1.91% for the week. I think you can see where I'm highlighting. Year to date, it's up 2.94, and over 1 year, it's 9.83. So from July 7th, 2022 to July 7th, 2023, the index, the market, and you'll learn more about what the Dow Jones Industrial Average is up 9.83%. The S&P 500 over that same year is up 14.64. Year to date, so far this year, as of July 7th, it's 15.58% up, and it was down 1.11% for the week. NASDAQ was down slightly, 0.91. It's up 31.12% for the year, and up 18%, over 18% for year over year. Bonds were down also. I'm down here. I'm circling here. If you can see it under fixed income, that means bonds down 1.29%, up year to date just slightly. This is the Barclays aggregate bond index. This is probably the most common area I've shared with you before where investors hold their money, is in this, the bonds that are tracked by this index. And year over year, still down about 2.3%. The 1 to 3 year maturities, that's what that means. That's the Bloomberg US aggregate 1 to 3 years. So that's their bonds that mature shorter term, was down less, 0.08%, excuse me, for the week, and up 1.07% year to date. All right. If you're just listening, you should look at this on YouTube. Take an opportunity to look at these returns and some of the things I shared in the Slott report on YouTube. I think it would be helpful to you. Okay, so I want to share with you some information. I guess I'm going to be sharing my screen again, but I'll come back to this. But you remember that we're going to have a discussion in a few minutes about market indexes, right, or indices, however you want to say it. And it started with this big difference. We just went over the market returns, and year to date, the Dow Jones Industrial Average is up 2.94%. The S&P 500 is up 15.58%. So we had the last time we talked, almost a month ago, I shared with you a chart that showed some differences between the S&P 500 and the Dow Jones and why that might be. And we're going to go through that chart again, but the primary contributors to the return of the differences of the S&P 500 we talked about then is technology, right? The S&P the S&P 500 has an overweight in technology because of the way the index is weighted, and you'll know what I mean in a few minutes by that. Communication as well. Communication is has a higher weighting than the Dow Jones Industrial Average for the S&P 500. So the S&P 500 has a higher weighting to communication. Financial services, healthcare, consumer cyclical. So these all have higher weightings in the S&P 500. And you'll see when I share with you the top holdings, you'll see why that's happening. So now let's talk about some of the analyst reports. So Cornerstone wrote about manufacturing. Manufacturing continues to indicate a recession, but a strong consumer is helping growth continue. And this is really a conflicting issue that's going on right now. And when I read these analysts, is that interest rates have risen quite a bit. So the Fed aggressively has risen interest rates. We're at 5.25% now, and the Fed funds target rate. compared to, 0 or a quarter of a point not that long ago. And that started to help dampen inflation. We'll see more tomorrow, but the jobs are still very, very strong. So unemployment is still very, very low, and that's good. But one of the objectives of this rising interest rates is to help slow the economy a bit. But so we're really not seeing the slowing of economy on a greater scale. However, locally, I'm hearing people starting to slow down. My tree guy, right, who I shared with you that I had this big tree limb and land in my cars. Well, he was over looking at some of the other trees in our yard to see if there are any other risks, and he was saying for the first time in years he's caught up. So I also have a contractor at my house right now taking care of some things because he had no work this week, and he's a friend of the family. And I said, well, I've got a few things you could do. I haven't heard a contractor say he has, they had no work for a long time. Cornerstone writes, the service side of the economy continues to defy expectations of a slowdown, providing more fuel to the hawks on the Fed to believe that the economy can withstand higher rates. So maybe what we're seeing on the ground, what I'm hearing just recently, is going to expand across the economy and help the Fed see that, hey, we don't have to raise rates as quickly, but we'll, yet to be seen. All right, just one more point. They talked about the labor report, as I was talking about. So the labor report, after a strong ADP, so ADP had released a number last Thursday, but then the labor report came out and they had a softer than expected. 209,000 jobs were added in June, down from 306,000 in May, the slowest rise since December 2020. The unemployment rate came in at 3.6%. As expected, and wages rose 4.4% year over year, slightly stronger than expected. So that's interesting as well. Can't take a lot just from that one report, though. So we're going to talk about the NASDAQ 100, and we're going to talk about the Dow Jones Industrial Average. But you hear different things. There was this the FANGs. So what was it? Facebook, Apple, Netflix, Google, and I can't remember what the other, Amazon. So they were the big holders in that moving most of the indices, and then it was the mamas, MA. And now it's the Magnificent Seven. So let's talk about what the Magnificent Seven that they're talking about and that are driving the NASDAQ 100 that we're going to talk about later in this. And that's Google, Microsoft, Amazon, Apple, Meta, Tesla, and NVIDIA. So this is an overconcentration, and we're going to talk a bit about that. But this author is saying that watch out for these rebalancing changes, because these indices, like the NASDAQ that we just talked about, and the S&P 500, they have to, certainly the NASDAQ, they have to rebalance at a certain period of time, and their weightings can change. But you'll see in a moment how most of the market is being driven really by these 7 issues. As I said, Google, Microsoft, Amazon, Apple, Meta, which is Facebook. Google is Alphabet. The company is actually called Alphabet, but it trades, the ticker is still GOOGL. Apple, Meta, Tesla, and NVIDIA. So I think that's interesting. Now, BlackRock, and somebody asked, why do you share BlackRock as one of your analysts? I follow BlackRock. I've followed them many years, but they're one of the largest money managers in the world. I know they're getting in some political territory that some people don't like, but I try not to pay attention to that. They have great research reports from all over the world, right? They have research analysts in-house on the ground in different areas, and they have different divisions. So I'm going to talk a little bit about their iShares division, which is their exchange traded funds. Again, not a recommendation to use BlackRock. I don't currently have any BlackRock holdings, not that I'm opposed to them. They just don't fit our screens right now. So the iShares mid-year outlook, I'm going to share some key takeaways. So they're holding tight for higher for longer interest rate support for high quality bonds. They write fixed income. I'm going to try to give you the layman's terms on this. But when you hear stock or equities, that means stock. When you hear fixed income, that means bonds. So they're holding tight on their high quality fixed income right now. They're looking for new opportunities in equity markets, stock markets. They say the stock markets are priced for an optimistic outcome. Investors may want to consider steering towards a defensive stance. Mega forces mega soon. It says trends such as demographics and artificial intelligence are impacting present day returns, not just in the future. So we're already seeing the effects of these new technologies. Let's see. I'm not going to read all this to you, but they basically talk about the. I'll read the first couple of paragraphs. The first half of 2023 has been characterized by opposing narratives, as I was just talking about. In the recessionary data camp, we've seen a slowdown in manufacturing sector coupled with tighter credit conditions following March's banking turmoil. Excess savings rates have fallen, especially in lower income households. Excuse me. On the soft landing end of the spectrum, however, the labor market remains incredibly robust. Again, what I was just talking about. So the labor report came in with lesser jobs, higher, the slightly less. The income amounts were up. I think it was 4.4%. So the labor market remains incredibly robust with unemployment rates hovering near all-time lows. Inflation has moderated only slightly, despite the Federal Reserve hiking interest rates 5% to levels not seen since 2007, pointing to a resilient consumer buoyed by stable earnings potential as wage growth remains firmly above the pre-pandemic decade. Again, what I just said. There might be less jobs, but higher wages, and people are still feeling confident about their purchasing power. Still, despite divergent signals in the macro data, financial markets kicked off the year with a stellar start. And I think, when you're talking about, the S&P 500 being up 15% so far this year, that is a stellar start. Okay. So it is 10:32. We're going to switch over to our financial planning topic. I hope that was helpful. I know, I know these analyst reports can be conflicting, and that's what I like to share with you, because I want to look for different opinions. And these are some of the brightest thinkers out there, and they really don't agree with how things are going. And the reason I share with that is to give you some background and so you can make smart investment decisions, and if your clients, so you understand where we're coming from. But, it all comes down to nobody really knows, of course. So how do you guard yourself against significant losses in the markets, but have the ability to take advantage of growth? And my theory, we've got to start with strong asset allocation, good components of your investment models. Principal protection is vital, and account segmentation, where you divide up your accounts so that they're specifically funding each time of your life. If you're in retirement, if you're nearing retirement, you treat things a little differently, but that's really how you manage this. And you want to be defensively optimistic. We want to be optimistic about the growth of our nation and the world, but we have to be defensive. Whether you're, again, just coming into retirement, or you're a few years or many years into retirement, you don't have a lot of room for mistakes. You younger folks out there, of course, you can still make mistakes, but there's no need to, right? You don't want to be haphazard about it. Okay. I hope that's helpful. All right, let's switch over to our financial planning topic. So let me just get my board together, and I promise you, I will try to stay within my time. Okay, so here we are. I'm hoping that you can see my whiteboard, and this is the Financial 15. And today we're going to talk about investment indices. And if you're just joining us for this section on YouTube, I'm going to ask you to hit the subscribe, like, and notification button so that you're always on top of what we have going on. Okay, so this is what I was talking about. So, and again, if you're just joining us, what you did miss was, about a half an hour of our weekly webinar, and I read some updates about IRA distributions and some things to watch out for. And I talk about the markets, what happened last week, and I read and share my thoughts on some analyst reports. And this Financial 15 is the last 15 minutes or so, sometimes more, of that webinar. And so if you want to go back and find that webinar, you can do that. But let's dive into this. So this is the chart I shared with you a couple weeks ago. And this is kind of what inspired me to have this discussion about indices. So I'm not going to go into this chart here, but it really came down to the fact that the performance, let's see, at this point, it doesn't give the total performance, but we just reported that the S&P 500 was up over 4%, or excuse me, the Dow Jones Industrial Average as of Friday was up over 4%, and the S&P 500 was up over 15%. So it really, someone said, well, what's the difference? Why is it? I mean, that's a big difference. 11% is a big difference. And you can see that it has to do with how the indices are weighted and what's driving those indices. So let's talk a little bit about this. And again, as always, a lot of information you'll see. I'm just going to zoom out so you can see all the information on the board here that I want to go over as quickly as possible. So stay with me. So we're going to first focus on the S&P 500 here. And I got to make sure I'm not covering things up. So the S&P 500 was launched in 1923 with just 233 companies. So it was two different companies. I forget exactly what they were called, but they came together, I think in 1941 to form Standard & Poor's. It's market cap weighted. So what does that mean? So let's pull over here and I'll share with you what market cap weighting is. So now I love these little snippets, and this isn't something I wrote. It's something I researched and pulled in for you, but it's from investopedia.com. And I like to use things that you can go out and find yourself. And I have to tell you, I get an email from investopedia.com every morning that gives me a financial term. And I love that. I just, sometimes yesterday it was a term called kurtosis. And it's something I knew very, very well when I sat for my CFP exam, but something I don't talk about every day. So it's always nice to be reminded of these things. So market cap, what is market cap weighting? Market capitalization, I'm right here. I'm trying to be mindful not to cover up my content with my picture. Market capitalization refers to how much a company is worth as determined by the stock market. It is defined as the total market value of all outstanding shares. To calculate a company's market cap, multiply the number of outstanding shares by the current market value of one share. These should be tradable shares that are in the market, not restricted shares or things that aren't traded in the open markets. Companies are typically divided according to market capitalization. Large cap, you'll hear, or large companies are $10 billion or more. Mid cap is $2 billion to $10 billion. And small cap or small companies is $300 million to $2 billion. Market cap is often used to determine a company's size, then evaluate the company's financial performance to other companies of various sizes. In investing, companies with larger market capitalizations are often safer investments as they represent more established companies with generally longer history in business. You can't just disregard that, right? That's not my recommendation. That's something that came off of Investopedia, because there have been some changes. Let's see, this might be a good segue. Yes. So remember that just said that these are typically more established companies with longer histories and safer investments. But here's where they may not be safe because they're a component of the S&P 500. So read this with me. Beginning here, the S&P 500's most recent rebalancing was announced on March 10th, 2023, and took effect before markets opened on March 15th, 2023. SVB Financial Group was removed from the S&P 500 index due to the failure of its bank, Silicon Valley Bank. The Federal Deposit Insurance Corporation took the group into receivership, making it ineligible for inclusion into the index. It was replaced with Insulet Corp. Similarly, on the same date, Signature Bank was taken into FDIC receivership and was removed from the index and replaced with, I guess that's Bungie Limited. So that's important. So don't look at that and say, okay, I'm just going to invest in the S&P 500 because they're safer investments, because that's not the case. Oops, I didn't mean to move that. All right, let's pull back over here to my list. Whoa. So that was market cap weighted. I hope you understand a little bit now about what market cap is. Returns mostly driven by the top weighted companies. So let's see. I think I have this over here. Whoops. Oh, let's talk about this. This is the example of an S&P 500 market cap weighting. That's right. All right, here's Apple. In order to understand how the underlying, whoops, you can't, I see I'm cutting myself off. All right. In order to understand how the underlying stocks affect the S&P 500, the individual market weights must be calculated by dividing the market cap of each company by the total market cap of the index. Below is an example of Apple's weighting. Now we're talking about the weighting of the company versus the index. So Apple reported 15.94 billion shares outstanding in its February 2023 annual filing for the quarter ending December 31st, 2022, and had a stock price of, I'm right here, just so you're following me, of $183.96 at the end of the trading day on June 21st, 2023. Apple's market cap is 2.89 trillion as of June 21st. The S&P 500 total market cap is approximately 36.79 trillion as of May 31st, which is the sum of the market caps for all stocks in the index. Therefore, Apple's weighting in the index was approximately 7.85% or 2.89 trillion divided by 36.7 trillion. Overall, the larger the market weight of a company, the more impact each 1% change in the stock price will have on the index. Don't pay attention to that. That was going into the next paragraph. So I hope you understand now what market cap is and how they're weighted. Now, let's see. I do have a list of the companies. Here we go. So here are the top 25 companies in the S&P 500. So let me just see how I can fit this in. We're not going to be able to fit them all in. And the weightings next to them. So we just heard about 7 companies driving the NASDAQ. Let's look at the top 7 companies in the S&P 500. They're the exact same companies. But if you add, you have to add Alphabet on here. The Class C. That's why the S&P 500 has 5. Actually, the S&P 500, I have it noted on there, 503 companies because different share class. We have Alphabet Class A and we have Alphabet Class C. But the same 7 companies are driving the majority of the returns of the S&P 500 as they are the NASDAQ. And you'll see more about that later. But these are the top 25 companies in the S&P 500 by weight. Hope that makes sense. I'm just checking to see if you can see it. Okay. You know what? I'm going to move this so I can put this down. Let's see. I'm just going to move my tablet down so I can draw on this better. And we talked about market cap weighting, that the returns are mostly driven by the top weighted companies. We talked about how that weighting works, right? With the example of Apple and 503 companies due to share classes. I showed you that. So Alphabet is actually shown in the top 8 twice because of the share class C and share class A. Institutional investors perceive the S&P 500 as more representative of U.S. equity markets because it comprises more stocks across all sectors, 500 versus Dow's 30. That's a fair statement. So now let's talk about the Dow Jones Industrial Average. Let's make this a little bit bigger. So the Dow Jones Industrial Average, it represents 30 U.S. company compared to 500. It's price weighted, and we're going to talk about what that is in a moment. And it was created in 1896 by a fellow named Charles Dow. So let's slide over here and see what makes up the Dow Jones Industrial Average. And I've got 2 lists of companies for this. So understanding the Dow Jones, understanding the Dow Jones Industrial Average. The Dow Jones Industrial Average is the second oldest market index after the Dow Jones Transportation Average. The Dow Jones Industrial Average was designed to serve as a proxy for the health of the broader U.S. economy, often referred to simply as the Dow. It is one of the most watched stock market indices in the indexes in the world. While the Dow includes a range of companies, all of them can be described as blue chip companies with consistently stable earnings. I think that's fair. Doesn't mean safe or any of that. But it does. It's a fair statement. So these are alphabetical, and that's the order they're in. We have 3M, American Express, Amgen. I'll just let you read them, and if you need to go back and look, you can. But these are the Dow 30. As of July 2023, this month. Now, that's how they're listed alphabetically. Let's see the top 10 weightings. So we have United Health, Microsoft, Goldman Sachs, Home Depot, McDonald's, Caterpillar, Visa, Amgen, Boeing, Salesforce. Much different than what we see in the S&P 500. And you're going to see the comparison to the NASDAQ in a moment. So I hope that's clear. I don't see any questions. You guys are quiet today. All right, now that's the Dow. Let's see if there's anything else here. Nope. Hope the zooming in and out isn't too confusing or bothersome, but it helps me. It's good with all this information. All right, so I struggled with this. We're going to just talk about the NASDAQ composite a bit. And we're also going to talk about the NASDAQ 100. So just for my own use, this index is probably what's quoted the most, although I could be wrong. But this seems to be what I hear the most, NASDAQ 100. So I want to include both because they are different. So the NASDAQ composite began in 1971. It is market cap weighted also. Can be non-U.S. companies. That's a big difference. And there's more than 3,000 companies represented in the NASDAQ composite. So I don't think I have a listing of all those companies, but I do have the NASDAQ 100. Now, NASDAQ 100 was created in 1985. It uses a modified market cap weighting. There are no financials in the NASDAQ 100. Can be non-U.S. companies. And of course, it's 100 companies, and it's actually 103. Now, let's look at what's in the top the top 10 companies in NASDAQ 100. So Microsoft, Apple, NVIDIA, Amazon, Tesla, Meta, right? That's Facebook. Alphabet class A and C. And then that leaves Broadcom and Pepsi. So if I went up and I grabbed the top 10 in the S&P 500, it's going to be the same, right? Just different weightings because how they weight their holdings. But I'm willing to bet that would be pretty close as well. So again, you've got 7 different companies driving most of the returns, certainly in this index, and certainly in the S&P 500 as well. So how do we compare investment platforms that are broadly based against an index that's returning most of the returns against with 7 or 8 holdings, if you include Apple, Google class C, and again, Alphabet is Google. Because that's the issue. If you had a portfolio of just these 7 companies, you would likely not feel diversified. But we're kind of demanding that from investment managers. And we compare them to these indices to compare their performance. And the question I have going into this year, seeing what we've returned is, and I've asked this before, is that fair? And the thing is that while we compare investment performance of individual managers, whether they're mutual funds or actively managed outside money managers, we wouldn't accept a portfolio that is just held with seven stocks. So is it fair to compare the performance of those managers who have a broader direction other than just beat the index against the S&P 500 or the NASDAQ? Because what the heck am I talking about? I'm sharing with you a Morningstar report for a very a typical mutual fund. So you'll see that I X'd out the name because I didn't want this to be viewed as a recommendation to own or not own this fund. So let me make sure you can see what's going on here. And you'll see here, I circled it a little bit, or I covered it up with my circle. This thing sticks sometimes when I do that. It'll come back in a second, but I hope it does anyway. Sometimes when I use the eraser portion of this pen, this happens, and I ought to know better. Yeah, there's all my squiggles. So let me just back those out. All right, let's try this a little differently. Let's use this eraser. Okay. The reason I went through that, what I wanted you to see here was the index that we're comparing this to. So we have the Russell 1000. Listen, I talked about the S&P 500, the Dow, and the NASDAQ. There are, I don't know how many other indices or indexes, however you want to say it, but there's a lot. So I just chose the most common. So benchmark one on this is the Russell 1000. Obviously the top 1,000 companies in the US, and the second benchmark is the Standard & Poor's 500 or the S&P 500. So what am I talking about? So here's the return on this year. So as of May 2023, I'm over here. So let's give some direction here. I'm over here. So May 2023, the net asset value, that's the price of the mutual fund, is $35.83. The total return year to date as of 5/23 was 6.38%. So what does this mean? Plus or minus benchmark. So that means comparing it to the Russell 1000, this fund underperformed that benchmark by negative 14.37%. So what we'd want to do is go back to that Russell 1000, see what the makeup is of that Russell 1000, just like I showed you with the Dow Jones and the NASDAQ and the S&P 500. But most importantly, see what the top holdings that are not necessarily, I guess it would work out, the top 10 holdings, but certainly the top weighted holdings and what's driving the return of that index. And is it fair to compare it against a broad-based mutual fund that is supposed to invest in large company? These style boxes up here show us that this fund does go and switches a little bit, but right now it's kind of in between large company growth and large company value, and it's right in the middle. So its direction should be a little differently than just chasing the top 7 stocks within an index. But you might look at this and say, oh, wow, this fund stinks so far this year. We're paying a fee, and this fee on this fund is 0.5%, I think it is. We can find that in a moment. But you could say this is underperforming, and maybe we should get rid of it. And that might be a fair assessment, but I would say it's probably a little unfair. And again, that's one of the reasons I'm not sharing the name of the company or the mutual fund with you, because I don't want this to be seen as a recommendation, just an illustration of how a proper evaluation might be applied to an index versus an actively managed portfolio. But you see, last year, if we're using the same metric, right, this fund so that was a negative year. Right. So this shows the markets were down. This shows here the markets are up. That was a negative year last year, and the return was negative 14% of the fund, but it outperformed the Russell 1000 by 14%, so lost just about half, and outperformed the S&P 500 by 3.76%. So you've got to look at, is there a history of underperformance? It's underperformed here, underperformed here, underperformed here. So if you look back, and I would say that this is probably just a broad brush, I would raise concerns about this investment because it has a history of underperforming the indices that it's tied to. However, like I said, I wouldn't throw it out necessarily just for this year or for significant up years, because of the concentration in the indices. Now let's see if we can find out I'm looking for the expense ratio here. Let's see. That's the cost on the fund here. So it looks like 0.55% is what the costs are of this fund. So you got to ask yourself, and this is answering that question, how do we use these indices to compare them or research investments? You got to ask yourself, is the savings of, let's make this clear. For example, last year, is the fact that you lost less in 2022 by 14.78% compared to the Russell 1000 and by 3.7% compared to the S&P 500. Is that worth the 0.55%? And then you also you can't look at that in a vacuum. You have to compare it to every other return. And that's just looking at returns. You should also be considering the philosophy of the investment manager, their team, and how long their team's been together, and do they have key people that are looking at potentially leaving. There's a lot more to it. I just want to share with you today how we use indices to compare to investments. So, okay, we've covered a lot, folks. Let's just zoom out here and see everything. Make sure we've covered everything. We didn't talk about, did we talk about price weighting? I don't think we talked about price weighting for the Dow Jones Industrial Average. I apologize. No. So let's just go back for a second for the Dow Jones Industrial Average, because remember, this is price weighted compared to the S&P 500, which is market cap weighted. So price weighting. So let's look at this. In a price weighted stock index, each company's stock is weighted by its price per share, and the index is an average of the share prices of all the companies. Price-weighted indices give greater weight to stocks with higher prices in terms of their contribution to the index value and changes in the index. A price-weighted index can be used to track the average stock price of a given market or industry. All right, so I hope that makes sense. That is different, and I think we covered everything else. Everything else looks like it. Yes. So let me go back here. Find my stinking. I have to go back up here. Okay, that's me. All right. So I hope that was helpful. It is 10:56. See, a little longer than 15 minutes, but we'll start breaking these up. I look forward to seeing you all next week. Yes, there will be a webinar next week. If you have any questions, you can reach out to us at questions@attleborowealth.com. Oh, let me see. Hold on. Maybe this is a good. There you go. Questions@attleborowealth.com or look at that. And then I even have questions. So you can reach out to us at questions@attleborowealth.com if you have questions, or if you want to schedule time with me. If you're a client, you can use the link that's on our website just for clients, just for you. If there's also a link to the website for folks who want to explore being clients of ours, or you can reach out to us again at questions@attleborowealth.com. And I hope that was helpful, and we'll see you all next week. And I think next week I'm going to do an overview of our new website, but we'll see when we get there. Have a great week, everybody. Take care.